Now we're going to pivot to Asia, and we're going to talk obviously about China and some of the things that we discussed throughout the last few segments. But we also want to talk about India and some of the issues that we've seen, some of the good, some of the bad, just given where we sit right now, and then other ASEAN nations as they struggle to come to the other side of COVID, with some pressure points when we're looking at South Korea data versus some of the other data that has kind of really come out over the last few days. And I'm actually just pulling it up just so I can talk about it as we progress forward, because it's just important to see what the estimates are, because sometimes I'll forget to talk about the estimates. So here's where we look at imagery today of the latest troop disengagement between India and China. There has been some disengagement when you look at some of these movements. India and China near Hot Springs and Gogra identifies a probable area along the river cleared where administrative camps have been locked in since 2020. But the PLA semi-permanent bases, however, remain right where they are. So you're seeing some movement. So you're seeing some adjustments, some disengagement, but they're still within striking distance. So they're still within striking distance. So they're still, I trust you, but not too much. But they're moving further away from the line of engagement or the line of actual control. And that's important, because if you reduce friction where people could potentially see someone, have a happy little trigger finger, the more you interact, especially with when tensions are high, there's a bigger and bigger chance for a problem. And by reducing that, you create a little bit more breathing room again, which is a net positive overall. So they're still engaged, but just off the lines and reducing some of that friction. We'd like to see this continue to move in that pattern. But when we look at China exposure, so as we said in the first segment, when we looked at who was the most exposed to Chinese trade, well, let's look at emerging market China exposure. Because when you look at who has the most exposure to China percentage GDP, Vietnam is one of the worst. Malaysia, Hong Kong, Malaysia, Taiwan. So this is where Taiwan, and this is the counter argument to China's never going to invade, because they can't afford to invade, because then it would create the strife. But at the same time, you can turn around and say, well, they view it as their own anyway, and it's an additional 22.7%, in that they essentially don't have to pay, because it's then part of the official government. So there's give and take to it all, but just highlighting some of those different pieces. Thailand, Korea, Chile, all have, Singapore exports to China as a percent of GDP. So as Taiwan, when you look at the economy, they're exporting a lot to China, and the foreign content percent, China's final demand in exports, you get an idea of just where some of this risk is. So as China slows, these are some of those underlying countries that could get that knock-on effect when we're looking at supply chains, when we're looking at some of those pressure points. And it's already started to show up, because when we shift over to the ASEAN manufacturing PMI, here's where we're already into this negative level. So we're into contraction. We're below 45. Remember, 50 is the level of 0% change. So we see this pressure, we see additional problems coming overall. And this is, again, you can see the fast bounce back, but this one's going to take longer. And it's because it's sticking around longer. There's, we're already so deep and so many problems on the supply chain side. This just makes things worse. And that's, I think, some of those counterpoints, which is why I think you're going to see some of this global growth get impacted based on some of these levels. Because it's not only just their GDP, but it's what does their GDP mean for the rest of the world, for trade, for travel. And again, these are some of those overarching problems that remain in the system. So then when we look at factory of the world, PMIs in Asia show manufacturing slowdown. So when again, speaking to what I just said about manufacturing, you can see Malaysia, 40, a PMI of 40. You look at Vietnam, 45. You look at Indonesia, 40. You look at China, 50.4. So you're either barely growing, and 50.4 is easily a margin of error. and then you have some steep declines. This is where we remain concerned in terms of what demand looks like, where that growth is showing. And remember, this is where the U.S. pulls a lot of their imports from. So when you look at where our imports are originating from, they're struggling on the manufacturing side, so the backlogs are going to grow. The cost that they're going to charge, that they're going to try to pass down, raw materials. You have all of these residual problems that are just going to remain well through 2021. And then when you look at the slowdown, work and retail activity continues to shift higher and continues to get worse when we look at work and retail activity in major Asia Pacific economies. So when you look at just the work and retail activity in major economies slowing, this is what we're talking about when we're looking at economic growth. What do we expect from a GDP and the local consumer? Because work and retail activity is speaking local. And here you can see how the pre-COVID level, we just haven't gotten there. And even though when you look at Australia, things got better, they had no cases, they never got back to normal, just touched it and kissed it and then fell. Then when you look at Japan getting a bit worse, India's on the mend, but starting to roll over. Not roll over in the sense of coming back down. That's a wrong way of saying it. Really flatlining and just not seeing that normalization, as South Korea just continues to kind of bump just below that zero level. And the capacity in China sinks amid efforts to control the virus outbreak. So when you look at activity, when you look at sea capacity, when you look at just what's happening for airlines, rail, subways, cars, this is the pressure that remains, and why we keep talking about the problems that exist within the underlying Asian economy. But where is there more money? And when you look at machines, so Asian hardware stocks are outperforming software, because when you look at the backdrop of one versus the other, here's where you're starting to see some of those pressure points, because hardware is the problem now, because there's the chip shortage. So for an example, there are people who are buying computers just to break them apart and sell the pieces if they can get a hand on the computer, because the internals are selling way above what they paid for the underlying computer. So the hardware shortfall is really being the biggest driver for where we are versus software. But what does that mean going forward? So when we look at a hand from the government, when we're looking at handouts and subsidies from the government to support semiconductor companies, you can see again that the China-based companies continue to get favored and remain to be the bigger push, because they want to control more and more of this industry as they see opportunities, and they're concerned about, well, what happens if there's more sanctions? What happens if I can't get access? We need to be more vertically integrated, and that's where the biggest focus has been, investing in these China-based companies. But the IMF is taking down a lot of these GDP estimates. So when we look at India, you can see India had the biggest write-down. And that's what for those that have been watching us, we've been saying since the beginning of this year, India GDP estimates made no sense. And now you can tell by the almost a 3% rewrite, essentially move lower, you're starting to get closer to where we think the market should be. But then when we look at Spain, China, Japan, you're starting to see some of that softness come back in. And I think you're going to see more of that as we go through and progress through Q3. And that's speaking to crude steel output. So when you're looking at why is that going to happen? Well, let's look at steel. So Chinese steel output fell sharply in the first 20 days of July, as we've seen a cutback on coal, on raw materials, trying to manage some of these prices. They've been selling from their spare state-owned facilities, trying to offset some of this price, and this is resulting in just additional slowdowns in that crude steel. But when you look at what is the speed bump that we see? So let's look at Indonesia. So when you look at retail sales, you can see retail sales have come down to 4.5. And then when you look at PMI manufacturing, it's down to 40. So when you look at, again, just pulling out because Indonesia's been struggling, they're also a fairly big importer relatively speaking, of refined products. So you're seeing this pressure that's just residing not only on the manufacturing side, but this is going to result in less diesel demand, gasoline demand, consumer purchasing, which is going to put more in the open market and keep some of those prices, depressed when you look at refined products in general. So then when we look at India and do a deeper dive on some of the Indian sides, so the new cases has flatlined. And that's one thing that we want to look at, because we're not out of the woods yet when you look at what is happening with new cases. And then when you look at consumer sentiment, it remains weak. So when you're looking at consumer sentiment, that means the consumer, based on gasoline demand was up 4.2% versus 2019. So they're willing to move about, but they're not really willing to spend yet. And that's where we see this bifurcation, and that's showing up more in diesel, where diesel is well below 2019 levels by over 10%, showing just, okay, consumer will drive, but no one's really making anything. And we're not seeing a lot of need for this move of products through the system, which is why when you look at the active cases going from 411 million to 532 million, again, you're speaking to, 411,000 to 532,000. You're seeing, again, that spike back up, which is just going to be something to watch. And we don't think it continues to go up, but again, we think it's just COVID's going to remain sticky in this area, and that's going to be a cause for concern, and not concern in the sense of a new lockdown, but just what are consumers going to do? What is the company going to do? Are we going to see some of this pullback or headwinds for underlying GDP, which then speaks to the inflation problem. So firms have yet to pass on the increase in underlying input costs due to weak demand. So this will change as growth and consumer confidence revive. So they've passed. I mean, when you look at prices in India pose a challenge to the central bank. When you look at WPI year over year at 12.07%, and then CPI at 6.26%, and this is before they've even started to pass on prices coming out of the second, local lockdown. So data coming out tomorrow or today, but based on when you're watching this, will show consumer prices rose 5.7% last month, cooling from a near 6.3% in June. Wholesale prices, which is that WPI, scheduled for release on Monday, are likely to show factory gate inflation at double digits for a fourth straight month. We import from India. India is going to continue to pass through as much of those prices as possible, but there's still so much more behind it, which is why, again, this is looking at inflation that is going to hit our shores in 2 months' time, 3 months' time, and just shows the amount of inflation coming down the pike. So then when we look at Japan, for an example, Japan labor cash earnings came down. A survey was for 1.1%, came in at negative 0.1%. Household spending was expected at 0.2%, came in at negative 5.1%. So you're seeing some slowdowns. COVID has come up a bit, not much, but again, Japan is still yet to get to some of that normalcy, even as when you look at what's happened in South Korea. South Korea unemployment rate has gotten a bit better, but there's still some of this overhang where we're just not getting back to some of that normalcy that we showed in those previous charts, looking at things on an aggregate, looking at those line charts, showing how comparing it to 2019 and just not back yet, and really not progressing further back towards either at 2019 levels or above 2019 levels. So that's when we start looking at these different surveys. But then when we look at that household spending, that is the biggest concern for local consumption, which, as we keep saying, remains very, very weak, especially in the Asian markets. So then when we look at global manufacturing PMI and China credit impulses, so every time I show this chart, China credit impulses have either gotten lower or have gotten flat. And based on what we've talked about with the money market, the triple R rates versus what the PBOC is trying to do, taking liquidity out, China credit impulses will flatline. They're not going to get much better. They're not going to get much worse, which when you look at just what this shows, and as we've started to see and continue to see, global manufacturing PMI is going to come down. And when you look at Germany, who relies a lot on Chinese imports in order to make some of their products, you're seeing those pressure points that are continuing to increase. And we keep talking about how China's GDP is weak. And we talked about it from the consumer perspective, from trade perspective, from the real estate perspective, from now let's look at investment. So when you look at excavators sold in China, China's major construction machinery firms sold 17,345 excavators in July, lowest since March 2020 and down 9.24% year over year. Domestic sales fell 24.1% year over year, down for a fourth straight month, as overseas does see an increase of 75.6%. But there's more of it is sold locally versus abroad. So you're getting an idea of that general slowdown. And this is typically a leading indicator for real estate development, housing, and again, corporate investment. If you're building a new facility, a new manufacturing facility, a new port, all of these just are pointing to those inherent slowdowns, which is why we talk about, thinking about those excavators. The COVID situation in China has gotten worse. Last Monday to Sunday, 524 new domestically transmitted symptomatic infections, up from 269, 124 new domestically transmitted. An outbreak in Henan province, separate from the Nanjing originated outbreaks elsewhere, is driving the latest numbers. And again, this is showing some of these problems in general. And given the numbers aren't huge, but just looking at how China attacks these outbreaks really dictates kind of where we expect to see that we're going to have additional lockdowns, different restrictions on provinces to try to protect from the spread. But there's becoming more and more pushback on this zero tolerance. And so far it has been defeated, and it's not gaining much traction at the highest level of the CCP. But they're starting to say, look, we can't afford to keep doing these lockdowns, and maybe it's okay to do softer lockdowns and not be as strict, especially if what we're seeing is true. But there's also concerns about the efficacy of the Chinese vaccine, and that can be said for Pfizer and some of these others, given some of the efficacy. But these are some of the real problems that continue to hit the local economy as the local growth has slowed, and having an additional lockdown won't help that. Now, China's exports, you can see just looking at by dollar value, you can see it's still elevated versus any other time. But remember what they're doing on PPI. We still see, and this comes down to value versus volume. On a dollar level, it's still elevated because when you look at the value of it is going up, they're passing on prices. So the volume can actually be lower, but the value is going to be elevated. So then when we break that down into Chinese trade, here's where we can look at what the expectations were and what actually came to pass. So when we look at exports, and this is looking at it in terms of yuan, you can see exports, the expectations were for 9.6%, came in at 8.1. Imports were expected at 21.9%, came in at 16.1, bringing the trade balance to 362 billion yuan. So when you look at exports, again, exports are slowing. We talked about this last month as we saw this coming down. But look at the imports. So imports are still elevated, which means that we're still going to see year-over-year growth in exports. It's just that the demand is dwindling, and those problems on the supply chain are also impacting China, which is going to slow down some of that growth. And as you have renewed port shutdowns, more provincial lockdowns, more restrictions on travel, that's going to increase the pressure on the Chinese economy. So then when we look at this a little bit differently, let's look at PPI. So CPI year over year, the expectations were for 0.8%, came in at 1%. PPI was expected at 8.8%, came in at 9%. So just gives you an idea of the amount of pain or pressure that remains in the system when we're looking at what has happened with China and how is that pricing coming through. So PPI returned to the 13-year high seen in May. On a month-over-month basis, prices increased 0.5%. These numbers come despite officials' best efforts to bring down prices. That is the key. Even though the CCP has tried, we're just not seeing the impact because pricing pressure is too powerful. That includes repeated auctions of raw materials from state reserves, but that doesn't necessarily mean that Beijing will further ramp up efforts to cool prices because, again, there's also base effect. Base effect mean that China is unlikely to see a further acceleration, but it also doesn't mean it'll fall. And that's the biggest conundrum that we keep trying to drive home. Just because it's not rising doesn't mean it's going to come down. And that's where we see some of the stickiness. Higher producer prices have still not filtered into the more sensitive CPI numbers, but it's coming because there's only so much that the companies can hold back, which is why there's so much concern on the consumer and at the CCP level. Consumer prices have instead been pushed down by falling food prices, which dropped 3.7% year over year in July. Core CPI, which excludes food and energy, remains tepid. It rose 1.3% year over year in July, compared with 0.9% in June. One bright spot, prices in the service sector rose by the most in 23 months, expanding 1.6%, which suggests that service sector activity improved last month, echoing less strong PMI data. But widening travel restrictions to control the Delta outbreak will negatively impact the service sector in August. Officials are just going to have to ride out this period of producer price inflation. So again, there's that mixed bag in terms of where we are. But speaking to the credit impulses, money supply was down. And the reason why we talk about it, so M2 was expected to be 8.7%. It came in at 8.3%. M1 was expected at 5.4%, instead came at 4.9%. So you're seeing some of this get, again, pulled out of the system. And it's this managing because it's still up, but it's a matter of managing liquidity. And it's because it's actually missing estimates, it means that credit impulse, again, is going to remain depressed, but it also will also impact the ability to get financing and to invest in everything from real estate on down. But that's also part of the goal. We've seen housing prices come down. The goal is more affordable housing, trying to come after that, especially given the amount of off-balance sheet debt that remains in the system. So then when you look at the Chinese producer prices surge while consumer, this gives you an idea of just where things sit and how we've started to level off. And this is what we think is going to continue to remain over the coming months. So when we think about PPI, we have to consider what is being done. So Guangdong issues the 14th five-year plan for high-end manufacturing, with, shocking, the focus on semiconductors, the goal to develop Guangdong into a semiconductor manufacturing powerhouse. That means having all points of the supply chain covered, including raw materials, design software for high-end chips, advanced fabrication technologies, advanced packaging and testing, high-end chip manufacturing equipment. This is a long-range plan, and considering China's massive semiconductor talent shortage, there's no guarantee it will succeed. So they don't only need the equipment, which the U.S. has increased restrictions on what can be sold to China, but they also need PhDs. They also need highly intelligent and highly trained individuals. And given the demand around the world for this individual, you don't have to go to China. You can go to the UK, you can go to Germany, you can go to Japan, Taiwan. You can go to the highest bidder and where you can invent things and own your IP versus China where that still remains a bit more cloudy. So that's going to be something that's going to have to be addressed, especially when you think of where some of these elevated levels are and what those pressure points are going to remain. But then when we look at China's foreign exchange reserves, so let's look at the foreign exchange reserves, which came in at $3.236 billion. So according to SAFE, China's reserves rose to $3.236 trillion at the end of last month, the highest level since December 2015. But since 2017, the PBOC hasn't directly intervened in the currency, but large Chinese banks have, to the tune of over $1 trillion, and presumably those dollars, euros, are also available. So when we look at 3.2 plus Chinese banks, what do we have? 4.2. So there's 4.2 trillion with at least another 1.1 trillion at the CIC. The government has access to over 5.3 trillion of liquid foreign assets to cover 2.5 trillion of external debt. But as we said in segment 1, look at where they've invested. You have a lot of stuff that has come underwater. As we said last week, the special purpose bonds, they've allocated over 3 trillion renminbi to be invested locally. Only 1 trillion has been done because there's that off-balance sheet risk. So based on this, even if they had to write down all of their the BRI, the Belt and Road Initiative, the problem is now when you look at Evergrande and you look at how much off-balance sheet they have and how much of that is offshore. So it may look like things are okay, but how much of that debt is sitting there as a landmine to offset some of this capacity, and how much of these assets have been, let's just say, have seen a continuous double counting, if you will, on collateral, which again creates a much bigger problem overall. So when you look at China currently absorbs foreign demand equal to cover 0.7% of the rest of the world's GDP, again, a net positive for some of that growth when we're looking at that offset for some of the slowdowns in GDP, there is some of that benefit on the other side. So then when we look at some of the misnomers and again, driving further down this level of financing. So according to Caxton, China's total non-financial debt as a percentage of GDP has declined for the third straight quarter, the first time this has happened since 2008. But it's just not true. So according to the National Institute of Finance and Development, China's debt to GDP ratio fell by 2.6% in the second quarter of this year. It fell by 4.7% percentage points since the end of last year and by 5.8% from its September 2020 high. But when you look at the debt data, so now let's look at the debt data. Debt data provided by the PBOC, total debt rose 2.3% in the second quarter, or 9.6% annualized, 5.9% in the first half, 12.1% annualized, and 7.7% since September 2020, 10.4% annualized. So in order to get the debt to GDP ratio to fall, you'd have to, now because debt went up, you'd have to have GDP grow, but it has to grow faster than the pace of debt. But when you look at what has happened so far, the calculation is like for debt to have grown in line with PBOC data and leverage to have fallen in line with NIFD claims, GDP would have had to grow by an annualized 14% since September 2020 and by an annualized 16% year to date, or by so when you think about it, so clearly it didn't happen. But why is this the case? So it is just that they're using the model of a lagging four-quarter model that doesn't fully use approximations, if you will, to try to estimate where things are going to go. So it'll get better over time as it catches up with itself. But when you look at the wrong assumptions after last year, which makes their model essentially useless when you're comparing leverage ratios versus this year. So that's why when you look at it, will rise over the rest of the year. And that's why when you look at where the debt is, so you had the fall based on what it is, but it's a lagging indicator. So as it catches up, all of a sudden you're going to get this big spike in debt to GDP, but it didn't spike. It's just truing up and catching up with itself. So that's just something to consider when we look at the fact that debt to GDP is still bad. It's still getting worse, especially because you have GDP that has slowed. We continue to talk about how it's slowing more than even expectations, and debt continues to get issued to provide some sort of support. All the while, gaming companies face more regulatory risk. So they've come after tutoring, and now they're coming after some of this gaming side. And when you look at the tech sector in general, it's coming under additional pressure within China. So I know we covered a lot. We try to put as much effort into this and as much data and information to give you that holistic picture. If you have any questions, please let us know. Comments, we love the back and forth. You can always find me at markfny on Twitter. I look forward to hearing from you and having some great discussions. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.